Good afternoon, everyone. Very sorry for the slight delay. We're having some audio issues. Hopefully the audio will be clear, but you may want to raise the volume on your computer or phone, whatever you're listening on. So thanks for attending this final session of our Best of BlackRock event. Shortly we'll be talking to Chris Brinkman, who will be telling us about Latin America and BlackRock Latin America. Latin America has had 2 strong years of performance compared to global markets. Year to date, BlackRock Latin American is up 13% in NAV total returns, ahead of the benchmark. This follows a strong 2022 for the index and the fund. Chris took over the portfolio, I think, in September 2022, so he's had a good start to his tenure, and he'll be talking to us about portfolio shortly. Before I hand over, just a reminder that if you'd like to ask a question, you can do so by writing in the box on the right of the screen. We've got 25 minutes or so reserved for the presentation, and then we should have 15 minutes or so for questions. So with that, I will pass over to Chris.
Yeah, thank you so much for the introduction, and I hope that people can hear me clearly. I'll try to speak loud and clear. And yeah, thanks so much for your interest. My name's Chris. I've been working for BlackRock for the past 8 years, and I've been named on the fund along Sam Beck for the past year. And I first wanted to give you a few details about the fund. So the fund has around $170 million in AUM. The target tracking error is around 3 to 6%. We're usually in the higher range of that, between 4 and 6, because this is an active fund. BlackRock and other institutions offer you a lot of passive index funds to give you index returns. So we believe in active management, and we also believe that active management is particularly important in emerging markets and in Latin America, where the stocks can be quite volatile. The other thing that's important to mention is that the trust is able to gear up, so we can deploy leverage, and we can express views on the market that way as well. So if we're quite positive on the market, we will obviously be more geared, and our neutral level of gearing is usually about 5%. The other important thing to highlight is that we are style flexible. That means that we don't have a growth bias, we don't have a value bias. We only care about the quality of the company and the stock. And the reason why I mentioned the AUM at the beginning is that the relatively lower AUM gives us the ability to move down the liquidity curve as well, and invest in some stocks that are less liquid, giving us more options and a broader universe, and essentially a bigger universe to generate alpha. The other thing that I think differentiates us from competitors is that we have quite a specific macro process that determines our top-down asset allocation, where we essentially try to determine where in the economic cycle specific countries are. We have deployed this process for a very long time successfully across the emerging markets, and we do so in Latin America as well. And it's important to highlight that the process tends to work quite well for countries that run current account deficits and that are hence dependent on foreign capital. That applies to most of the countries in Latin America. And so we think that the macro process works quite well. The other thing I would like to mention is that we are part of the bigger emerging markets team. We have around 30 investors. Half of us are based in London, half of us are based in Hong Kong. And all of the people that work on the Latin American Trust are based in London, and we all sit next to each other, which makes the communication much easier. So having said that about the team, I think I wanted to then move on to our current outlook for the region. And we think that Latin America is very attractive at the moment for 3 reasons. First, we are going through a period where there's a lot of geopolitical conflicts across the world. We think that these geopolitical conflicts will be with us for probably the next decade. And Latin America is fairly neutral within those conflicts, as I will go into in a few minutes. So we think that that Latin America will be either more isolated from those conflicts or actually benefit from them. The second point is more macroeconomic, which is that EM central banks have been very proactive in terms of raising interest rates. Many of them are now able to cut, and we think that the direction of travel for economic activity in these countries is positive. And the third point is simply that stocks and assets in Latin America are very cheap. And those are the key reasons on why we are positive on the region. So thinking about the first point, here we have a slide that shows how different countries have voted during the United Nations vote for Russian reprimands. And to us, it is clear that we're moving from a unipolar world order that was dominated by the US to a more multipolar world order where you have two leading powers, China and the US, in competition. And so that the next decade will look quite different from the past 2 decades. And what you can see is that the map is colored in blue, which is essentially the countries that are more aligned with the West and the US, colored in red, which are the countries that are aligned with China. And there's also quite a lot of countries that are yellow, which we would call neutral. And so we think the world is splitting into 3. And we think that the countries that are able to trade with both sides might be able to fare better. Both from a simple trade perspective, but also in terms of foreign direct investments and nearshoring of supply chains, for example. And Latin America is a very good example of that. Brazil is currently running one of the strongest trade balances it has had in a very long time, which is supporting the currency. In Mexico, you see both Chinese companies as well as US companies, as well as multinational companies set up new plans and essentially diversify their supply chains, which is giving a positive external shock to the country. And even in a country like Argentina, you see quite a lot of leniency and support from the IMF for the country. And at the same time, you see the country receive swap lines from the Chinese. So the region is being seen as quite strategic for both sides, which in our view leads to foreign direct investment from both sides. And also has a positive impact on the trade balances of these countries relative to the rest of the world. And so that's one of the key reasons why we are positive on the region. The second point is more macroeconomic. And so what I would like to highlight here is the point that central banks in Latin America have been very proactive in terms of raising interest rates. So what you can see on this chart is the spot real interest rate, aka the policy rate within the country minus the inflation rate. So for example, if you think about the UK currently has a central bank policy rate of 5.25%, but inflation in the UK is still at 6.7%, which means that you have a negative real interest rate of minus 1%. If you look at Brazil, for example, Brazil has a central bank policy rate of 12%. It has a CPI of 5%, meaning it has a positive real interest rate of 7%. We think that this is very attractive for investors, which attracts foreign capital flows into the country. And B, we also think that this is a very restrictive monetary policy for the country itself. Because if you have to think, like, if you take out a loan at 15%, it's very expensive. So at the moment, it's very hard for companies in Brazil to borrow money. And at the same time, consumers in Brazil also tend to buy a lot of things on credit. And that has also gotten more expensive. And so what that means is that if you have such a restrictive monetary policy rate, the economic activity will weaken, and that has already driven down inflation. And so if you think about the central bank meetings of this week in the US and the UK, the debate in the US, for example, is still whether interest rates have to be higher because monetary policy is not restrictive enough. and the economy is still quite strong. In Latin America, we're already at a different point in the cycle where interest rates have been raised quite early and quite fast. Inflation has come down, economic activity has come down, and so from here on, interest rates are actually being cut. And so we have already seen countries in Brazil, in Chile, in Peru cut interest rates, and Mexico and Colombia will probably follow over the next year. And that means that the direction of travel for economic activity going forward is positive. And based on a macro process, we essentially want to invest in countries when interest rates are high, when activity is weak, and when asset prices are cheap. And all of these points currently apply in most of Latin America, which is why we're quite positive on the region. And within Latin America, we are probably most positive on Brazil. And then, as I said, one of the key aspects where we want to invest is we want to buy assets that are cheap. I think everybody would like to do that. And so this slide shows how cheap Latin America is. Latin America is the green line. And you can see that Latin America in aggregate trades on a 9 times price to earnings ratio compared to 12 times in emerging markets, which itself is also expensive, but 19 times in the US. And you can also see that the US market on the bottom chart, you can see that relative to its own history, the US is fairly expensive and Latin America is fairly cheap or very cheap. And that's another reason why we are positive on the region. And based on that, I think I want to go a little bit into some of the countries. And the first country I wanted to talk about is Mexico. And I've talked about how we think the world is splitting into 3 factions. We talked about how companies want to diversify their supply chains. And the top chart here shows that this is not just a narrative, but this is actually already happening, and there's data that is backing that up. And the top chart shows the share of manufacturing goods exports to the US. And you can see, again, with the green line, that Mexico has overtaken China as key trade partner for manufacturing goods. There's a lot of anecdotal evidence of different companies setting up new plants in Mexico. Tesla is one known example that is still debating about where to set up their plants. And this is leading to an increase in foreign direct investment and a positive external shock to the country, which is why the economy in Mexico has been fairly strong, which is also one of the reasons why interest rates in Mexico will probably still stay elevated longer than in some of the other countries in Latin America. And the bottom chart shows that this has also already affected the returns of equity prices over the past 2 years. And so you can see in the bottom chart that Mexico has outperformed the S&P 500 over the past 2 years since the pandemic, which is something that is not something that I would have expected 3 years ago. And because of that, in the Latin American funds, we're actually currently a little bit more neutral on Mexico because returns have been fairly strong, and so we have taken some profits. But we are definitely still exposed to the nearshoring theme by being invested in industrial real estate companies such as BRWM, for example. And then I've also already talked about how Brazil is one of the countries that we are most positive about. And I briefly wanted to talk a little bit about the political outlook as well, which is important in all of Latin America. We have the sense that a lot of investors, especially local investors, have been a little bit more cautious about the Brazilian equity market over the past year. And that cautiousness is largely centered on concerns around the new president, Lula, who has taken office back in January, and whether he is committed to a balanced fiscal budget, because Lula likes to increase social spending, which obviously doesn't have to be a bad thing for society. It just needs to be funded from somewhere. And what I wanted to highlight on this slide is that in the lower part, you can see that contrary to his first 2 terms in office in the early 2000s, Lula does actually not control the Congress. He doesn't control the lower house, and he doesn't control the Senate. And so that means that passing any of his agenda through Congress is actually not that easy. And this has already played out this year, where a lot of his proposals have been blocked also by Congress, which is why we are more confident than a lot of other investors that the fiscal outlook in Brazil will be fairly benign, especially relative to where expectations are. This has already played out in somewhat this year, where the Brazilian government, the finance minister, has announced a new fiscal framework that has been more conservative than the market expected, which has led to a rally in Brazilian assets in the earlier half of this year as interest rates have come down. Over the past few months, we have seen some renewed concerns about the budget for next year, because what the finance ministry is trying to do is they're trying to raise revenues to finance Lula's social spending. And they're again seeing some pushback in Congress. But we think that over the next few months that Congress will do the right thing for the country and help the finance minister to reach a fairly balanced budget. And then I think, so overall, I think it's important to highlight that we do have good checks and balances in the Brazilian Congress that we think will limit Lula's ability to push through market negative reforms. And then I think the other point that is interesting is that in Brazil, we're currently debating whether the fiscal deficit will be between 0% or 1%. Whereas if you look at the UK is running a fiscal deficit of around 6%, and the US is running a fiscal deficit about 6% as well, while we're in a peacetime economy and while unemployment is actually fairly high. And so people always perceive emerging markets in Latin America as more reckless in terms of their fiscal spending. But overall, we actually think that Lula in Brazil, but also AMLO in Mexico, they're actually running a much more fiscally prudent policy than a lot of the developed market counterparts. And so having said that, I very briefly wanted to touch upon performance. We've already mentioned it in the introduction that Latin America has had quite good performance over the past 1 and 3 years. Over the past 2 years, Latin America has been up 50% in US dollar terms, whereas emerging markets have been fairly flat since then. And we think that relative to a lot of the other markets and countries across the world, that the outlook for Latin America remains fairly positive. And then I wanted to talk a little bit about the positioning of the fund. And as I mentioned at the beginning, our team has a very defined macro process that determines the top-down asset allocation. And I would say that the biggest bet that we currently have in the fund is being long domestic Brazil. Brazil represents roughly 60% of the benchmark. And you can see here that our active country allocation to Brazil is actually not positive. In this case, like as of end September, it was actually negative. But within Brazil, we are underweight exporters and we are overweight domestic stocks. And so the biggest bet in Brazil is definitely interest rate sensitive domestic stocks in Brazil. So for example, if you look at the sector allocation, you can see that we are overweight consumer discretionary, we are overweight real estate. And that is the case because we think that interest rates in Brazil are too high, which has already decreased economic activity. Inflation has already come down. And so we think that the central bank will be able to cut interest rate much more over the next year. which should help interest rate sensitive stocks. So for example, we have quite a lot of exposure to the Brazilian retail sector at the moment. The reason for that is that most of these companies are reporting quite weak third quarter results because it's quite expensive for consumers to buy things on credit. In addition to that, like in other parts of the world, the weather has not been that great. And so people, like a lot of retailers, have quite a lot of inventory that they need to go through. And in addition to that, the government is trying to raise taxes on the sector. And so a lot of these consumer discretionary stocks and retailers in Brazil have come down a lot and traded very cheap multiples. And we generally try to take a different view and time horizon than a lot of the local investors. Local investors often tend to focus on the next quarter or the next, mainly on the next quarter. And so that's why they're selling these stocks simply because the weather has been bad. But we tend to take a view 12 to 18 months out. And we think over the next 12 to 18 months, the outlook for a lot of these companies will be a lot better. And the same for real estate. As interest rates come down, mortgages will become more affordable, and the valuation of house builders should go up. And then if we go back to, I guess, the country allocation, we're currently, like Mexico represents 30% of the benchmark. We're currently slightly more neutral on Mexico after having been overweight for the past 3 years or so. That is simply a result of very strong returns of the equity market, and also maybe some slight concerns about the U.S. economy, which has been really strong this year. But we think that the U.S. economy will, with a lag, also respond to the high interest rates and slow down over the next 6 months or so. And we think within Latin America that Mexico will be most sensitive to the U.S. economy, which is why we're more neutral. Argentina shows up as an overweight, but we have no exposure to the country itself. These are stock-specific positions. One of them is an oil pipe producer. The other one is an IT outsourcing company. And we are overweight Colombia because it provides us with cheap exposure to the oil price. I think that covers most of what I wanted to get through. But just to go back to what I mentioned at the beginning, is that we are currently quite positive on the region, and we are overweight Latin America in our emerging market funds. And the reason for that is because we think the world is splitting into 3 factions. We think that the faction that is neutral will benefit over the coming decade by being able to trade with both sides. We think that Latin American central banks have been proactive in terms of raising rates. You have seen inflation come down. We've seen economic activity come down, and so now rates can get cut and the economy can improve. This is almost the opposite of where the U.S. economy is. This is also very different from where the U.K. economy is. The U.K. economy is currently slowing down quite rapidly. The U.S. hasn't even slowed down yet. And so you are yet to see the negative impact of the slowdown in U.S. earnings, whereas in Latin America, we've already seen quite a bit. And from here on, we think the direction of travel is positive. And then lastly, as I highlighted, Latin America is very cheap. And so that's why we're positive on the region. I'll probably stop there, and I hope there are a lot of questions.
Great, thanks, Chris. Yeah, we do have a number of questions, but if you're in the audience, we've got plenty of time, so don't be shy, please. Question picking up on Mexico, asking about, how does it compare in terms of the costs of doing business for multinationals to China? Is it a lot more expensive than China?
Yeah, that's a very good question. I don't have the exact number in my head, but what has happened over the past 10 years or so is that the minimum wage in China has crept up quite materially every single year. And so today is actually not that far away from the US anymore. And Mexico's minimum wage has been stable over that period. And so on a relative basis, the minimum wage in Mexico has become a lot cheaper relative to China. And so I don't have the exact relative delta in my head, but it's definitely a lot cheaper. So especially in terms of operating expenses, Mexico is definitely much cheaper. In terms of CapEx, obviously, building plants in China at the moment is definitely probably still cheaper. But I guess the reason why companies choose Mexico as a destination for supply chain is partially about cost, but it's also partially about safety and security of supply chains and just diversification. And so that's why we think that the trend will continue.
Picking up on that, is Mexico then competing with India? What does Mexico have that India hasn't? Because India is also stealing a lot of business from China. I guess physical proximity is a pretty strong advantage.
Yeah, so I think the view of our team, emerging market team, is that we see this benefit of supply chain diversification. We will see this both in Asia and in other regions such as Mexico. And Southeast Asia, countries like Vietnam, for example, certainly also benefit quite a bit from diversification of supply chain. And so I would like, in some sense, Mexico might be competing with Asian countries for that. But we think that the key aspect is really diversification. And so Southeast Asian countries are probably more gaining share to actually supply into China, or supply into the region, supply to South Korea, or even supply to India. Whereas we think that Mexico is the key country where supply chains are being relocated to supply to the North American market. So we think that both regions can actually benefit.
And on the dividend point, we have a question about whether you think another special dividend could be in the offing this year. So I think the trust paid a special last year. Is that right?
It is something that we can think about, but I don't think it is planned at this point in time.
We'll wait and see. So you showed Argentina as being a kind of an overweight position there. Clearly, there's been quite an interesting political story unfolding there, and some very volatile markets as a result. Could you perhaps tell us how you view Argentina from that top-down perspective, and maybe how you deal with these political situations? Because politics is clearly very important in a lot of these markets. Yeah,
so Argentinian politics is certainly fascinating and also very hard to predict. So I traveled to Buenos Aires back in July. In July, all the politicians and all the political analysts were convinced that the market-friendly opposition, Cambiemos, would win the election, potentially even in the first round. And then in August, we had the primary elections where essentially it's been decided who is the candidate for the different parties. And during those primaries, the liberal populist Milei has done very well. The current government, the Peronist, led by Massa, has also done very well. And the market-friendly opposition has actually done quite poorly, to the surprise of everyone, which again shows you how difficult it is to forecast these things. And then we had the first round of the election where, again, Massa, who's the current finance minister, has done well. Milei has done well. And so we now have a run-up election on the 18th between those two candidates. And the market-friendly opposition is out of the race. And so we think that the current government has created a lot of imbalances within the economy as they do not want to devalue the exchange rate while still running a high fiscal deficit, which means essentially they give out a lot of money that the central bank is printing, which is why you have inflation of 120%. which is why in theory the exchange rate should depreciate, but they're holding that constant. And so that has created a lot of distortion within the economy. And they've also held a lot of prices constant, which they shouldn't have done. And so there's a lot of imbalances that need to be addressed that depress economic activity and make just normal economic life within the country quite difficult. So, for example, most Argentinians try to spend their whole salary every month because they know it's going to be worth less in the following months. So nobody who's being paid in pesos is able to save in any way because their savings are being reduced by inflation. And so it's definitely quite a mad situation in the country. And we think that the country needs to go through a certain shock therapy to adjust those imbalances, which can be quite painful in the short term, but unnecessary for the long term. And we don't think that these changes will happen before the new president will take office. And if Massa wins, which currently looks more likely, we think they will probably choose smaller changes than if Milei would win. And we are not sure whether you can get out of the current imbalances by doing small changes here and there. And so we generally think that the economic outlook for the country is quite difficult, which is why we do not have much exposure to the domestic economy and only invested in certain stocks that have exposure to the global economy. The one thing that I do want to highlight, though, is that the one exciting thing about Argentina is their oil and gas field, Vaca Muerta, which is an amazing oil field with very low lifting costs and amazing economic returns for the producers, better returns than like most fields in the U.S. And so there are certain companies like this, certain companies that are exposed to the oil and gas sector that we think can be quite good investments over the next 2-3 years. We are currently not invested because we still want to wait for the economic imbalances to be addressed. But we certainly think that this can be quite a positive for the country over the next 2-3 years. And so that's why we keep looking at Argentina quite closely and keep monitoring the situation.
What about the energy transition then? Is Latin America still reliant on fossil fuels, or does it have exposure to the greener energy sources? There's a lot of mining that goes on in Latin America. Is this a theme in the fund, copper mining and so forth?
Yeah, so there's obviously a few countries that you haven't talked about that much over the past minutes. I haven't talked that much about Chile, Peru, and Colombia. And regarding the global energy transition, I think it is worth highlighting that Peru and Chile represent the two largest producers of copper, and their economies and their external balances are quite linked to copper. And so the fund and the trust certainly is exposed to the energy transition by being invested in copper, such as in Grupo Mexico, for example. And we think that we'll probably increase the investments over the next year or so. At the moment, we are not at max position within that theme because we are still somewhat worried about the outlook for the global economy. And copper obviously is quite a cyclical metal that is quite exposed to the global economy, especially to the Chinese economy as well, that has had some problems within their property sector over the past year. And so that's why at the moment we do not have full positions within the theme. But Latin America as a whole certainly benefits from an increase in demand for copper. And we can express that via our positions in Chile and Peru. And then the other thing that is really important to highlight about energy transition is that Latin America is also one of the biggest producers of lithium. Chile, again, is one of the biggest producers of lithium globally. Argentina also has a lot of lithium, like large lithium reserves. And so we are also exposed to electric vehicles by being invested in SQM, which is one of the largest lithium producers globally, that is also trading at a quite attractive valuation. And here again, it's important to highlight that the Chilean lithium assets are one of the best in the world, and mining lithium, or like mining lithium from the salt lakes in Chile is actually much more environmentally friendly than mining lithium from hard rock assets in Australia, for example, because you need less energy to get out the lithium. And so that's why we like SQM quite a lot.
Fantastic. So I've got one more question from the audience to ask. We're coming up to time, but if you're in the audience and you'd like to ask your question, please put it now, and we'll try and squeeze it in. You mentioned, I think it was Petrobras trading on a very high dividend yield. Why is it so high? And is that because it's much cheaper than Exxon and Shell? And if so, why is that?
Petrobras is definitely cheaper than most oil companies globally. One of the reasons is that it is a state-owned company, and as we now have elected populist government in place in Brazil, there have been some concerns again by the market about government interference. And so that's why, especially in the first quarter of this year, the stock has traded at very cheap valuations. But we think that over the past decade, the corporate governance of the company has changed quite a lot. The bylaws have changed quite a lot. And so we think it's much more difficult for the government to interfere within the company. And this is an outcome of the corruption scandal that we had in Brazil under the Dilma government back around 2015. And after that period, the corporate governance for all state-owned entities in Brazil has improved a lot. And there's been a lot of laws passed that make interference more difficult, and that also make individuals much more liable for any wrongdoing. And so that's why we think, again, like that the concerns by the market are probably overblown. And so that's what, and then the other reason is that Petrobras has already gone through a capex cycle and currently does not have that many projects that they need to spend money on. So the free cash flow yield is very high, and because they don't have that much capex that they need to spend it on, they can pay out money via dividends.
Brilliant. Well, thanks very much, Chris, for your presentation and answering all those questions. And thank you to the audience for your interest. We hope it was interesting and useful, and we hope you enjoy the event this week. This presentation and all the others should be available on our website very soon, where you will also be able to find our written research on the trusts. And we hope to see you at our next event. So thanks very much, Chris. Have a good afternoon, and bye to everyone.
Thanks, everyone. Bye-bye.